Welcome, accounting boffins. You are with Ashraf Patel and the crew. Yes, guys, the focus of today's lesson is the income statement, and also very often you'll find it is now referred to as the statement of comprehensive income. So, have you thought about this here? What is the statement of comprehensive income and why is it necessary to do it? Obviously, the statement of comprehensive income is drawn up at the end of your financial period, right? So, just like you, at the end of your year, you get a report, and your report indicates your performance for the year. In the same way, a business needs to know what has been the performance of that entity during the financial period, okay? You will see now, and remember also what we are saying, that it is important to complete this statement of comprehensive income. Reason is that when you are doing this comprehensive income, you want to determine the amount of profit that has been earned in your financial year. Now watch the choice of words. We're saying income that is earned and expenses that are incurred. Keep these two words in mind because we're going to refer to them continuously when we're doing the statement of comprehensive income. So now, what's the procedure? What happens at the end of your financial year? So you have your financial year end, right? At the end of the financial year, you have what is called a pre-adjustment, pre meaning before, right? So obviously, all the figures that are appearing in your pre-adjustment trial balance are the amounts that we have received and we have paid. Look at the difference of words. Remember we said the idea to determine the profit is what? Income earned and expenses incurred. So therefore, my pre-adjustment trial balance has not taken into consideration some of the adjustments that we have to do, which are deemed necessary for us to complete in order to correct the amount of profit that we have earned in this financial period. Okay, so from your pre-adjustment trial balance, you now move on to your adjustments, right? Now that's what's going to be our focus. But before we go there, let us look and see what does a statement of comprehensive income actually look like. Let's look at the format so that you understand exactly how to go about completing a statement of comprehensive income. We start off with our sales, and notice what we've done for you here. We've actually shown you a calculation in brackets, right? And that's one of the first things that you must do. Whenever you are working with a question on the statement of comprehensive income, you will not be told what to do with regards to this particular adjustment. And I'm referring here to your debtors allowances. So the first step that you do is go into your trial balance, find your debtors allowances and subtract it from your sales. Now it is imperative, it is important, it's absolutely crucial for you to show your calculations in brackets, because you can be rest assured that you always get part marks when it comes to showing your calculations. So remember, as a golden rule, when you are doing the statement of comprehensive income, make sure that you show all calculations in brackets. Okay, so my sales less my cost of sales, and you notice in accounting that when we are subtracting, we're indicating the figure in a bracket will give me my gross profit. Okay, so what is that? Sales less cost of sales. Now obviously the cost of sales may also be subjected to a calculation, but like I said, this is just the format that we are concentrating on for now. I then bring in my other operating income, and once again There could be more than one operating income. All that I've done, I've listed one of them, obviously to show you the format. So we have rent income, and once again, the important component that we're referring to here is the calculation in the bracket. We're going to come to the adjustments just now. For now, just focus on the format of the statement of comprehensive income. That will then give you your gross operating income. Notice, you have your gross profit, add your other operating income, and in this case here, it's the 12,000 Rand to give you your gross operating income of 234,000 Rand. Okay, you now bring in your operating expenses. Now these are all the expenses that we have paid, and remember what we said, the expenses that we have incurred during the financial year, right? But more about that just now. For now, remember, it's your operating expenses, and you list each one of them, right? Starting off with the figure as it appears in your trial balance first, then your adjustment, and then the final total. Okay? For now, don't be too concerned about the calculation. We're going to do each of these adjustments individually, and then you will see why we're using either a plus sign or a minus sign. For now, focus on the format. So you have your operating expenses, you've listed all your expenses, and that will then give you your operating profit. Okay. You now bring in your interest income, again, calculation, right? Once you have your interest income, you add it to your operating profit, and that will give you your profit before interest expense. Now notice, it is important, guys, that interest income and interest expense do not form part, your income does not form part of other operating income, and neither does your expense form part of operating expenses. These two are shown separately at the bottom of your income statement, and for a very good reason. Remember, they are not operating expenses, they are financing expenses, and therefore they are shown at the bottom of your income statement and always shown separately. That will obviously, you subtract your interest expense, and that then gives you your net profit for the year. So what you have seen here now is basically a summary of what a statement of comprehensive income looks like. Okay, this means therefore you now have to go in and do your adjustments. Which are your adjustments? I've alluded to debtors allowances. Remember, the reason for the minus sign indicates you will always subtract the amount. Sales less debtors allowances. Got that? Okay. When it comes to accrued income, it's always a plus sign, right? Whenever you're dealing with an accrued income, remember, the operation in the bracket is a plus. You're adding, because it's an income that you've earned, but you haven't received it, so you're debiting accrued income. Credit the income account. Deferred income will always be a minus. Why? You're debiting the income account and crediting deferred income. Why? You've earned income which you did not, which was not for this financial year. It is income received in advance. Then you go to prepaid expenses. Once again, the operation is a minus. You've paid an expense already this year. It was not for this financial year, but for the next financial year. Therefore, you subtract the amount. Accrued expenses will always be a plus sign. Why? You've incurred the expense, but you haven't paid for it as yet. Therefore, you got to add to the expense. So you see, that's the reason why we use these operations when we are showing our calculations. Then you get your consumable stores on hand, and this is the value of consumables that you haven't used, minus sign, minus in the operation. Okay, so therefore, we go on to other possible adjustments that you could get, right? You could get your trading stock deficit or your trading stock surplus, right? Once again, what do you do here? you compare your physical stock take at the end of the financial year with the stock figure as it appears in your trial balance. Now remember, that trading stock figure has to undergo a few changes before you finally make a comparison between your physical stock on hand and the amount that appears in your trial balance. But the trial balance figure obviously would be subjected to other adjustments if necessary. Depreciation, okay, we all know that depreciation is an imputed expense, and here the two methods of depreciation, where we use the cost price method or the diminishing balance method. Know both of them. We've dealt with them before. Here we deal with it as an adjustment. Bad debts, an expense to the business, those debtors that did not honor their commitments, and we had to then write them off as irrecoverable. Provision for bad debts, something new. It's a negative asset. It reduces the value of my asset. We will deal with it in more detail when we come to an example. But remember, also an adjustment. Then obviously, your salaries adjustment, salaries that have been paid in advance or salaries that have not been accounted for. Obviously, these are adjustments that you will be doing. And then interest on loan, a very important one, because here we talk about interest being capitalized, and obviously we will do an example for you where you will be able to see what we mean when we say interest is being capitalized. So in other words, if we have to summarize what we've done so far, you must firstly start off with your pre-adjustment trial balance, do all your necessary adjustments, show your adjustments in brackets, and thereafter you indicate the final amounts in your income statement. As an example, here's your rent income. The amount was 14,000 in your trial balance. There's a minus 2,000, obviously telling you that you debited rent income and credited income received in advance to give you your final figure of 12,000 Rand. Okay guys, we're going to be going into the actual adjustments now. So if you want to know more about these adjustments, you have to stay with us. We'll see you just now. Welcome back, Accounting Boffins. Yes, you're with Ashraf Patel. Our focus is the statement of comprehensive income. A quick recap. Remember, in order to do your income statement, you're working at the end of the year, your financial year end. You're working with a pre-adjustment trial balance. You're going to do your adjustments, and thereafter, you're going to complete your income statement. Got it? Brilliant. Let's move on. Okay, here's the information that we have. We are told that the rent income was received up to January 2020, right? Take into account that the trial balance figure is 126,224. Your financial year ends on the 31st of December 2019. You are told that the rent was increased by 12% on the 1st of August 2019. Right? Okay. Now, when you get an adjustment like this here, what is important for you to do is write down the information in such a way that it makes sense to you. Watch. This is how we go about doing it. Start off by saying, you don't know what your old rental was in Rand value, but you do know that it was 100%. Okay? So step number one, let the old rental be 100%. Number two, your old rental, that means prior to the increase from January to July, because remember, the rent was increased in August. So from January to July, your rent was old rent, meaning 100% for how many months? 7 months. So watch what you do. You say 7 times 100, which was the percentage, to give you 700. What was that? The old rental. Got that? Okay. Then the new rental. Your new rental was from August, right? Up to January. Why January? because you have already received the rental in advance. They're telling you you've received rental up to January 2020. So therefore, you count now from August to January gives you 6 months of the new rental, right? Again, in percentages, step number 1, how many months? 6 months. The rental was increased by 12%. Therefore, your new rental is 112. Multiply 6 times 112 will give you 672. Right. Now you take the percentages. Add 700 plus 672 will give you 1372. Look at your layout, very important when you're doing a calculation of this nature. The layout of your work so that you know what you are doing. 1372 is equal to the given figure in your trial balance, the total of rent income as it was given to you in your trial balance. So you've drawn up an equation. So what are you saying? You're saying that 1372 in terms of percentages is equal to my rand value of 126,224. Got that? Okay, what do I do now? I say, okay, what am I looking for? I'm looking for the 1 month rental that was received in advance. Clearly, the month that I have received in advance was a new month. It was January, the new year. So therefore, it was a month which has a percentage equation of 112. As you can see, there's it. You know that the January rental was 112%. 112% is equal to your unknown. Therefore, I'm telling you that the new rental was increased by 12%. So therefore, 100 plus the 12 will give you 112. Okay, you now say cross multiply. 1372x, right, is equal to 126,224 times 112. You then solve for x to find x to be equal to 10,304 rand. Okay, so this is your calculation now. What have you done? You've ascertained that the rental that you've received in advance for the 1 month is equal to 10,304. Okay, now, obviously, firstly identify the adjustment. What is this adjustment? We've received income in advance, so we're definitely dealing with a deferred income. So step number 1, you know it's deferred income, and what do we know? Deferred income tells us that the operation in the bracket is a negative, a minus. We go to, what's my double entry? A debit to rent income, in other words, decreasing your rent income. This is the T account, if you have to see it. There's your rent income. You're going to debit your rent income and you're going to credit your deferred income. There's the entry. Okay, this means therefore, in my income statement, I will start off my rent income with the figure that's given to me, 126,224, minus deferred income, minus 10,304 to give me my final figure of 115,920. So that's the amount that will be reflected in my income statement. At the same time, what we've done here for you is we've shown you that when you're doing your statement of financial position, or you're doing, or also another name for it is the balance sheet, then in your balance sheet, under trade and other payables, you will have an amount called deferred income, the same transaction, and therefore the 10,304 rand. So we're showing you the link between the income statement and the balance sheet. Notice that an adjustment will impact on both the income statement for the operating expense and in the balance sheet for what? For the deferred income, which is a temporary liability. Okay. The next adjustment we go to is a salaries adjustment. What are we told? In this adjustment, we are told that the financial year end, once again, 31st December 2019, we are told that salaries and wages amounted to 175,000 and employer contributions amounts to 35,000. Now, these are shown as two separate expenses. However, keep in mind, they could also appear as one expense where your employer contributions could be part of salaries and wages. Depending on the question, it will indicate to you whether it is two separate expenses or whether they are shown as one. What are we told? We are told there that one employee was omitted, left out from the salaries journal for December, and that was the information, right? The net salary was 46,000, the employer's contribution was 9,800, and the deduction was 14,500. So that's the information that we have regarding the one employee who was omitted, was left out. We now bring in that adjustment. What's my double entry? A debit to salaries and a credit to my liabilities. Who do I owe money to? I owe to my employee. How much do I owe? 4,600. Sorry, 46,000. Right? I owe my employee 46,000. I owe the deduction, which was for SARS PAYE, an amount of 14,500. Okay. Now, I also have employer's contribution. This is a separate expense because it's shown to you separately. And watch, this is how we go about doing the adjustments. Firstly, in my salaries and wages, start off with the trial balance figure, which was 175,000 plus 60,500. Where's the 60,500 coming from? Watch, 46,000 was your net salary plus your deduction of 14,500. If you add these two amounts, you're going to get a figure of 60,500. Okay, so here we go. There's my 60,500, which in fact is my gross salary, right? So remember this, net salary plus deductions is equal to my gross salary. Okay, so what amount do I want? I want my gross salary. So you're debiting salaries and wages with the 60,500 to give me my total new salaries figure of 235,500. Okay. Now you go to employer's contribution. You have the 35,000, again, trial balance figure, plus the employer's contribution for the one employee was 9,800. Add it, gives you 44,800. So what's my double entry? Debit salaries, which I did. Credit my liabilities. Which are my liabilities? I credit creditors for salaries, and I credit my PAYE, right? SARS PAYE. Those were my two in respect of the gross salary of the employee. Now you bring in your employer's contribution. A debit to employer's contribution of 9,800 and a credit. Who do you owe it to? The pension fund. How much? 9,800. So clearly you can see there are two separate entries. One was for the salaries, a debit to salaries and a credit to the liabilities that were created, and then a second entry for what? For the employer's contribution, a debit to employer's contribution and a credit to the liability. There we contributed to the pension fund of our employee, which resulted in a liability. We are owing the pension fund an amount of 9,800. Okay, very often, like I said, it could happen that these two are shown as one figure. What do you do in that case? All that you do is you add your employee's contribution, you add your employer's contribution to your salaries and wages, and you show it as one expense. That is also possible. Okay, the next one we come to is provision for bad debts. Remember what we said earlier on, provision for bad debts is what we refer to as a negative asset. Allow me to explain. Here's the example that you have here. You are told that you have to first write off a further bad debt of 8,360. Double entry, debit bad debts, credit debtors control. Straightforward entry, it's something that you're familiar with, you've dealt with before. It's a normal bad debt. It's a debt that which we could not recover. Having taken all the necessary steps, we could not recover the debt. Therefore, we write off the debt as a bad debt, debit bad debts, credit debtors control. Adjust the provision for bad debts to 10,480. In other words, you've got an existing provision. Let's look at it. There's my debtors control figure, right? There's my provision for bad debts, which is currently standing at 13,050. And these bad debts were bad debts that had been written off sometime during the year. Okay, so let's take this adjustment now and let's proceed with the adjustment. Firstly, we are told that we must write off a further bad debt of 8,360. So clearly, go into your bad debts account, start off with your trial balance figure, right? Debit the bad debts with the further bad debt we are writing off to give me a total of 17,810. Right, now you come to your provision. As you can see, you've got an existing provision of 13,050. What is provision for bad debts? That is your negative asset. What do we mean by a negative asset? It reduces the value of your asset. When you're drawing up your balance sheet, you say trade debtors less provision for bad debts. So therefore, if I've got a current provision of 13,050 and they're telling me that my new provision must be 10,480, if I subtract, I can clearly see that my current provision is too much. Therefore, what do I have to do? I have to reduce it, thereby debiting the provision for bad debts and crediting my adjustment account. Notice, when I credit my adjustment account, in other words, I'm reducing my provision for bad debts. When you are lowering your provision for bad debts, your adjustment account becomes an income, and therefore you show it under other operating income. So, what do we remember? When the provision for bad debts is being decreased, definitely the adjustment account will be an income. As you can clearly see here, an amount of 2,570. Okay. So, in my balance sheet now, I would have my trade debtors of 280,280 minus the further bad debt of 8360 to give me 271,920. I now say provision for bad debts. Which figure? The new provision. Remember that. Clearly you can see provision for bad debts, 10,480. You take your 271,920 minus, let's do that, 271,920, 271,920 minus 10,480, and that will give me a figure of 261,440. 261,440. So that's my net trade debtors. What's it? Trade debtors less provision for bad debts. Now, sometimes you find that you are told, let's use this example here now, you are told that you had further bad debts of 8360. We dealt with that one, no problem. But you are told, I'm changing the example now, just for your understanding. You are told that the provision must be increased by 2,000 Rand. So that means your current provision was 13,050. They are telling you increase it by a further amount. In this case here, we're increasing it by 2,000 Rand. So that means your provision for bad debts is 2,000 Rand. But watch, it now appears under operating expenses. So I've increased my provision. I've got 13,050. I'm increasing it by a further 2,000 Rand. Therefore, that becomes a further expense of 3,000 or 2,000 Rand. Why? I'm increasing my provision for bad debts. Therefore, if this figure now has to appear in my balance sheet, it will appear as 15,050. Why 15,050? Because I had provision of 13 plus that figure to give me my new provision of 15,050. This figure here appears in my balance sheet. But in my income statement, I will show the 2,000 Rand, which was an increase of the provision. So what do we remember from this here? When you are increasing your provision for bad debts adjustment becomes an expense. And when you are decreasing your provision for bad debts, then your adjustment account, like the previous example, becomes an income. Okay. So here's it. Remember what I said? That was your trade debtors, 280,280 minus 8360. Here's your provision for bad debts, 13,050 plus the 2,000 Rand to give me your new provision of 15,050. Let's look at interest on loan. And in the interest on loan, we are told that my loan was 1,725,500. I'm told that fixed monthly repayments including interest will be 31,600. I'm told that the interest must be capitalized, amounted to 242,500. And I'm told that the interest for the next financial year is expected to be 162,000. Part of the loan will be repaid within the next financial year. Now this is important. Watch. Look at my T account. I've got my opening balance of 1,725,500. I've got my interest that is capitalized, 242,500. I've got my bank repayment. This includes the interest of 379,200 to give me a balance of 1,588,800. So this here is your ledger account. You redraft your ledger account, putting all the relevant information that you have concerning your loan. Now this is important. Your loan was 1,725,500 minus the 379,200, you can clearly see there, plus the 252,500, and you are told that you're going to pay off your interest for next year is expected to be 162,000. So watch this figure closely, guys. You now take that figure of your 379,200, right? Let's do that. Let's take our 379,200. 379,200 minus, right, the interest of 242,500. And you see that you get a figure of 136,700. That was your repayment for this year. But they are telling you here, that you have to calculate your non-current liability in terms of what will it appear like in your balance sheet. Right. We're going to stop at this point in the question. We're going to take a break. When we come back, we're going to continue with this question on the loan so that you can see how it appears in your income statement, right? There's your interest figure for your income statement. And we're also going to look at the figure that appears in the balance sheet. We'll take a quick break and see you in a jiffy. Welcome back, Accounting Boffins. Remember, we were busy with the interest on loan. Once again, let's re-emphasize, when you're doing the interest on loan, make sure that you have the opening balance, right? Then you have the interest amount, then you have your bank. This includes your interest repayments, right? And then obviously you get your closing balance. Now watch, when you're showing your non-current liability in your balance sheet, again, opening balance minus your repayments plus the interest that was capitalized. When we say interest is capitalized, we're saying it's added back. As you can see here, it's added back. Your interest is added back, and this is then your short-term loan that will be repaid in the next financial year. Right. Obviously, more about that when we're doing the balance sheet, but just for income statement purposes, what do you need? You need this interest figure here, which goes to the bottom of your income statement. Can you recall interest expense? How much? 242,500. So depending on the information that's provided to you, you got to actually go and find out and work out your missing figure. So dependent on what is given to you. That is important. Okay, let's move on to the next one. There's a bank account adjustment where we are told that we received the bank statement from Yarona Bank. The following transactions were reflected: bank charges of 700 and interest on overdraft of 300. Very important. Bank charges is an operating expense. Therefore, under your operating expenses, you've got your trial balance figure plus your 700 to give you your total bank charges for the year. Double entry, debit bank charges, credit bank. Okay, but now watch. When it comes to the other one, we don't have it here, but let me explain it. The interest on overdraft will not form part of my bank charges. It will form part of my interest expense at the bottom of my income statement. Remember, that interest expense is made up of interest on overdue, interest on loan, which we just dealt with prior to this one here, then your interest on bank overdraft and interest charged by overdue creditors. So that becomes part of that interest expense figure, clearly indicating to you that interest on overdraft is not an operating expense, but a financing expense which appears at the bottom of my income statement. Okay. The next one we go on to is the insurance claim. The claim for stolen goods is 6,000 Rand, right? Rick's insurers agreed to pay 4,500. Clearly we can see here that as a result of this, we are going to lose an amount of 1,500. Why is that? Because the claim value was 6,000 Rand. The company promised to pay, the insurance company promised to pay the 4,500. So obviously we are going to lose an amount due to theft of 1,500. Again, read the question, see what information is given to you. Based on that, make the necessary adjustment. Okay guys, we're looking at consumable stores on hand, and remember the operation is a minus. Look at this here. If we look at our stationery, we are told that the stationery amount in my trial balance is 25,000 Rand, and the value of stationery on hand amounted to 5,000 Rand. Therefore, 25,000 minus your 5,000, meaning you have utilized 20,000 Rand worth of stationery. So this is when they tell you the value of stationery on hand as per physical inventory at the end of the financial year. Now remember something else. If they tell you the amount spent on packing materials was 25,000, and they are telling you the value of packing materials used amounted to 5,000 Rand. Look at the difference in the question. One, they told you what was on hand, and the other, they told you what was used. So therefore, when you are doing the used one, immediately the amount that you used is your answer. So therefore, if you look at this here, 25,000 minus the 20,000 will give you your 5,000. So take note of consumable stores on hand to see, are they telling you the value of the consumables that was left over at the end of the year, or are they giving you the value of the consumables that was used? Very important. RTFQ. Read the full question. Okay. Remember what we're busy with? Adjustments. We said the income statement, end of the financial year, you start with your pre-adjustment figures, you do your adjustments, and then you complete your income statement. Okay. Now, very often, candidates tend to get confused, or learners don't understand what do we mean by a reversal. Remember, a reversal basically means to reverse 5 adjustments at the beginning of your financial year. Which are the 5 adjustments that you will reverse? Accrued income, deferred income, prepaid expenses, accrued expenses, and consumable stores on hand. Now, when we did the adjustments, if you recall, these were the operations that we used in order to do our adjustments. If you look into your trial balance at the beginning of your financial year, right? Remember now, we're talking the beginning of the financial year. And if you find any of these items appearing there at the beginning of the financial year, right? It means, therefore, that the reversals have not been done. Let's just look at the procedure so we understand what we are doing. At the end of the year, you do your adjustments, right? What are your adjustments? Debit accrued income, credit the income account. Credit deferred income, debit the income account. Debit prepaid expenses, credit accrued expenses, and a debit to consumable stores on hand. So these adjustments are done at the end of the year. When it comes to the beginning of the financial year, you have to do reversals. That is, if the question has, in your trial balance section, under your balance sheet account section, if you find any one of these 5 items, it means that that reversal has not been done, and therefore, very, very important, accounting learners, make sure when you're looking at your trial balance now, before you even commence with your adjustments, remember you're at the year end, go through your trial balance section and see if any of these are appearing. If they are appearing, it means the reversal has not been done, and therefore you must now do the reversal. Here's an example for you. If you look at your information, they're telling you consumable stores on hand when at the beginning of the year amounts to 50,000 rand. Okay? So that's your value of your consumables at the beginning of your financial year. This therefore means, right? And I'm going to explain it to you in terms of the income statement as well as the ledger account. Okay? So here's your item, packing materials. Okay? You are told that at the beginning of the year, there was packing materials on hand to the value of 50,000 rand, correct? What was my reversal? My reversal was a debit to packing materials of 50,000 rand, and obviously a credit to my consumable stores on hand, because remember, you had this as a balance, and now you are doing the reversal. As a result, you are transferring it back to the packing materials account. Okay? So that is what we mean by a reversal. So the same thing that you do for packing material, for consumable stores on hand, where you transfer it back to packing materials, you will also transfer accrued income, deferred income, accrued expense, and prepaid expense. These are what we refer to as our reversals. Okay, so there's my reversal for consumable stores on hand, transferred back to packing materials. There's the 20,000 rand that was purchased for the financial year, and there's your 8,000 that's left over this year. So clearly you can see 50 plus 20, there we go, minus the 8,000, there's your final figure that will appear in your income statement. So what's very important is go and check in your trial balance section, under your balance sheet section, is there any item that needed to be reversed which was not reversed? Focus on the 5: accrued income, deferred income, accrued expense, prepaid expense, and consumable stores on hand. Let us summarize what we have done in today's lesson. We are working at the end of our financial year, so we're working, preparing a statement of comprehensive income. Okay? Another name for income statement. This process takes place when? At the end of my financial year. So you've got to look at the dates that you are working in. The year probably started in January, ended in December, or the year started on the 1st of March and ended the 28th of February. So that tells you what is your financial year end. Okay? You start off with your pre-adjustment trial balance, right? That means all the figures that appear in your pre-adjustment trial balance under the nominal account section are the items that you're going to indicate on your income statement or your statement of comprehensive income. And thereafter, right, before we even move on to our adjustments, we're going to look for, what are we going to look for? Any of the reversals that have not been done. Okay? So even before we come to our adjustments, look for any of the reversals that have not been done, and thereafter, obviously, you go in and do your adjustments. Okay. Always remember that an adjustment has a double entry. For example, a debit to accrued income and a credit to the relevant income account. Also keep in mind that the impact it will have on your income statement, statement of comprehensive income, as well as the impact it will have on your balance sheet, right? In a future lesson, we will be dealing with the balance sheet in more detail. Today's lesson, the emphasis was on the income statement. So once you are done with your adjustments, you've now completed your adjustments, you've done your statement of comprehensive income, and you are now left with what we call a post-adjustment trial balance. In other words, after you've done all your adjustments. Okay, guys, that's the end of the lesson on the statement of comprehensive income. Make sure that you practice your adjustments, go through each one of them, look at the method we use where we start off with the trial balance figure, do the necessary adjustment, and most important, like I've said earlier in the lesson, show all calculations. From me, Ashraf Patel, and the team, keep your feet on the ground and be good. Until next time, goodbye.